Well, let's get across the market open now. Chris Weston joining us from Pepperstone. Chris, welcome back as we get
Morning.
into this Tuesday. Let's first start what we saw on Wall Street overnight. Certainly those trade tensions continue to weigh on investors, but also the latest manufacturing data, which, well, it certainly doesn't look promising, does it?
Well, I mean, you can read into it what you like. I mean, the headline numbers weren't great on the ISM manufacturing numbers, and the prices paid, which of course we're all looking at, was continued to be very elevated and an increase from from the prior month of April, and new exports were particularly weak, 47.6 or so. But I think the report was really dragged down by inventory, so that we gave this a bit of a wide berth. The market it was a bit of a blip on the radar. The market saw it as a bit of an inconvenience more than anything. But yeah, I mean, what we've seen really on the session was more about the flows, about the price action, rather than anything significantly fundamental. And we've seen a situation where equities have moved higher. Tech's done well. Energy's really led the gains on the day, but it's obviously the points been put in from Nvidia and Meta most prominently, and the Nasdaq's outperformed, and that's pushing the top end of its recent range as well. So that could feasibly break out. And obviously, if we were to see that, we were to see S&P futures pushing to 6,000 and potentially on. We're talking new all-time highs coming through in those markets. While we did see a little bit of sell-off in treasuries, market didn't really mind too much. But I think the trade really has been, buy US equity, and hedge out some of that risk, or hedge out some of your dollar exposure. People have lifted hedging ratios, and I think there's a widely held view now that the dollar's on a multi-year decline, to get down to sort of more average levels of purchasing power parity. And so you want to lift your hedging ratios, move some of that dollar capital out. And I think the gold market's telling you that they anticipate a structural bear market to come through in the US dollar. And that's really been the trade: buy US equities and a little bit of selling in treasuries, but sell out of that US dollar exposure, and buy gold as well. So a positive night, and that should certainly feed through into Asia today. I mean, the weaker US dollar story is really important for Asia, less so for Australia, but certainly for all those places with high levels of US dollar denominated debt. And we're going to see some positive opens in green across screen here today.
Yeah, further to your point, gold is flying again now, isn't it, Chris? I mean, we're likely to see the investors seek those further safe haven plays, do you think?
I don't know is this a safe. I mean, it is. I mean, gold obviously has many hats. You can hedge it, use it as a hedge against all different kinds of things. But for me, right now, with the move that we saw last night has certainly taken a lot of people by surprise. I mean, we weren't expecting to see the sort of gains that we saw, but it really took place through the sort of late session of Asia into Europe yesterday. This was not a factor of anything to do with any of the data flow that came out overnight. Certainly S&P Global Manufacturing, all the ISM numbers there as well. And, people are looking at trade, but I think this was more really about when the US dollar started selling off through that period. We did see gold starting to find buyers. We saw volumes in the futures really ramp up. And, you can put this down to Asia buyers really setting this off. So as I say, I think that there is a view out there that the US dollar, a month ago or so, 2 months ago, we saw the real effective exchange rate, the US dollar effective, at multi-decade highs. And this is where the Trump camp were coming out and saying they wanted a weaker US dollar to get it down to a more sort of fair value. A lot of the high surplus, current account surplus countries were running very high, had these current account surpluses, but their currencies were too strong relative to those fundamental theoretical values. And we are now seeing a situation where the real effective exchange rate on the dollar has fallen about 7% from those recent highs, and possibly just to get down to the average of those, the last 30 years, we've got about another 10% down to go. Now it's not going to get there in one foul swoop, but it will be a grind down to those level, I think. And while we don't see the Fed cutting rates anytime soon, they might not even cut this year. If we were to see the labour market showing signs of fragility and cracking later this year, then I think the US dollars that will be where we really run. So, I think that the gold market, for me, like if you look at the relationship intraday with the dollar, it does feel that people are saying, well, there is a high possibility here that the US dollar could go on a structural bear market. And, we want to be in gold in that situation. Silver also did quite well. So it was more of a sort of a broad sort of precious metals buy. But then obviously it does cover you for, any of the kind of trade risks that come through and any kind of geopolitical risks as well. But I think this was predominantly a US dollar move here. And I think the gold market is clearly sniffing out and telling you something about the future of the dollar in, over the next sort of 6 to 12, maybe 18 months.
Chris, just refocusing on equities locally, how's the ASX set up at the moment, given the ASX 200 getting pretty close to those all-time highs?
Yeah, well, if you're in energy stocks, you're looking forward to the open today because oil had a 3% rally. I mean, obviously we saw the OPEC guidance that they're going to increase barrels in July, but I think the market had pre-positioned for something potentially a bit more sinister. There'd been headlines that maybe they could go a little bit higher than 411,000 barrels, and the energy market has rallied quite nicely. So obviously S&P energy stocks will give us a really good line lead in for our market today. Tech did well overnight, and as I say, we saw Nvidia nicely up, and that looks like it wants to break 140 a close through there, and that could get a further momentum shift. People chasing that name. Broadcom, they report earnings on Thursday. The market's expecting about 6.6% move there. So look, it was that's going to obviously the ASX tech sector should find some tailwinds from that as well. But broadly on the ASX, we're expecting the market to open about 0.8% higher. And that takes us probably to 1.5% from the all-time highs that we got back on the 14th of February. So it feels like there is a bit of wood to chop once we get to that point, and whether people look to continue to buy the open and push it closer towards those all-time highs is obviously yet to be seen. I wouldn't be surprised if we did see a few people taking some off, but right now there's everyone's buying the dip. And the question is where is that dip intraday? Do you want to chase it, or do you just want to wait for a pullback? But those pullbacks are sort of on a daily basis intraday. 1.5% from all-time highs. Do we get a bit of wood to chop? But it feels like we gravitate towards those levels. If I was a betting man, which obviously I'm not, I would say that we are due to get all-time highs sometime pretty soon. But obviously it will take a Goldilocks kind of jolt, a job openings report in the session ahead. And then, of course, we've got the non-farm payrolls numbers on Friday. And I do think if we look at that, good news is good news for equities. Bad news is bad news for equities. I think it's as simple as that. I don't think, this idea that we get a weak jobs number, it brings the Fed in sooner and the equity market rejoices on that. I don't think that's the case. I think, global equities and certainly US equities are where they are at the moment because the unemployment rate is still very low. If we see any fragility in that, I think, the market will become very concerned about the flows. And I do think that the unemployment rate in the US is really central to where we are at the moment. So that non-farm payrolls number on Friday, very much key to the equity sentiment going here.